Hello everyone, welcome to the class of 14. We'll discuss about cost of capital today. And, as we discussed in a previous class, we discussed about the rate of return and the risk in the market. So we discussed about what the rate of return of the asset is determined from which process the rate of return of an asset is determined in the market. So what is the relationship between the rate of return and the risk in the market? So we explained that with the framework of the KPM, capital asset pricing model. And today we will discuss the cost of capital. What is the cost of capital? Actually, the cost of capital is the concept of the cost, which is viewed from the company's perspective, not the investor's perspective. If you look at this from the investor's perspective, it is exactly the same as the rate of return, which we have discussed in the earlier class. So the rate of return and the cost of capital is like a head and tail, the upside and downside of the same coin. So if you look at from the investor's point of view, that is rate of return. We will look at this as the company's point of view, it's the cost of capital. So we will discuss this from the cost of capital. That is the company's perspective today. And this is the generalized concept of the cost of the financial from the firm's point of view. All right, let me move on the concept. So we will discuss the firm's cost of equity capital first, and then move into the cost of a firm's overall cost of the capital later. What is the firm's overall cost of capital? Because a firm can finance, in the market with their issuance of the equity or issuance of debt. So the general route of the firm's financing is the equity and as well as the capital, as well as the debt. So if we are saying that overall firm's cost of capital, it should include the cost of the equity capital as well as the cost of the debt capital. So that is the overall cost of capital. So we will discuss this later. We call this as a WACC, weighted average cost of capital, which is the overall cost of capital. So we'll discuss later about that. But let me talking about where we do stand now. I mean, we discussed the capital budgeting, right? So and discussed about the net present value analysis, and discussed about the internal rate of return analysis. So all of the same concept, right? So when we discussed about capital budgeting, there always very critical, input we need to, consider. What is that? The discount rate. Depends on the discount, which discount rate we use. The whole discussion it can be different, right? Because the net present value is critically dependent on the discount rate. So whether which discount rate we use is the obviously most important the determinants when you're evaluating the net present value of the investment of the project. So that's why we discussed about the rate of return during the last class. The rate of return during the last class is actually the more general concept of the rate of return, more conservative rate of return from the investor's perspective. Today, we'll discuss about the rate of return, the discount rate from the company's point of view as a considered cost. So we are studying to discuss about the discount rate, which is the denominator when we evaluate the net present value. So I hope you just understand where do you stand now, where do you stand for this class, right? All right, let me explain the cost of equity capital first, and please look at this diagram, right? This is I think it is very familiar with you that this diagram shows you that if a firm have excess cash, what they'll do, actually they can do with two different options. First, they can pay the cash dividend to shareholders, or they can invest in new project, right? So they can choose between these different choices, right? So let's say that they paid the cash dividend to their shareholders, right? If the shareholders get the dividends, what the shareholders do next? The shareholders can invest in financial market. The shareholders can invest in the another financial asset in the market, right? They can purchase another stock, or they can purchase another debt, right? Or they can purchase another alternative asset, like infrastructure, or they can invest in housing. So they have a lot of the choices of investment in different types of financial assets, financial market. So they can earn some return from the investment in the market, right? But let's consider about the second option from the firm's perspective. The firm can invest in new project with their excess cash. What should they do? They should earn at least, they should earn a return at least equal or higher than the rate of return the shareholders can get from financial market. So this is very important concept. This is the cost of equity capital, right? So the cost of equity capital means the minimum rate of return can get from the fund's new investment. So, in other words, the firm should invest in a project which can get, a return equal to or higher than the rate of return from the financial market, from another financial asset in the financial market, where the shareholders can get from the financial market. Right? So this is the concept of the cost of capital, cost of the equity capital. Right? So again, the shareholders can reinvestment the dividends in risky asset in the market. The expected return on the capital budgeting, the expected return on investment in new project should be at least as great as the expected return on the financial market, on the financial asset in the financial market. So that is the basic concept of the cost of equity capital. Right. So let's say you are a new a CEO in a certain company, and you should decide whether to go on a new project. So what is the consideration you should make? You should evaluate the net present value of that investment, of that project, right? So whether the net present value is the positive or negative, you need to check, right? In the process of evaluation, you should use the discount rate. So appropriate discount rate. What is the appropriate discount rate? That appropriate discount rate is the cost of the equity capital, right? Because you need to, as a CEO of that company, you should provide the return to your shareholders, at least the return of an asset in the financial market. So you need to consider which is the minimum rate of return you need to get from the new project. That is the cost of capital, right? So I think we understand very well about this cost of equity capital. And let me move on to the next slide. All right. So how to get the cost of equity capital? There are two ways. There are two different approaches to get the cost of equity capital. The first one is the dividend growth model approach. We already learned about the DGM approach, so we can use the DGM approach to get the cost of equity capital. So I will explain about this later. And another way of the approach is that KPM. So capital as a price model. You can use capital asset pricing model to get the cost of equity capital. So let me explain about the KPM approach first. At this point, I'd like to emphasize, I'd like to address that, to get the cost of the equity capital is much more difficult than to get the cost of debt capital in general. Why? Why do you think so? As you guess, I think you will understand that difference. That is because that it is quite difficult to find directly observe the return that the fund's equity investors require in their investment in the market. That is because every investment has their very unique characteristics. So it is very difficult to typicalize, standardize the types of investment. So every investment is very unique. So it is very difficult to find the similar return of the investment of your investment in the market. It is very fine, the comparables in the market for the equity investment. However, for the debt investment, it is very easy to find comparables in the market, because even though the issue of the debt is different, the types of the debt is quite similar, because there are the components of the fixed income is very standardized, like the time to maturity, the coupon, right? And the types of debt. So it is very, even though the issues are different, the types of debt is very similar. So you can find the similar characteristics, in the market, as your own debt securities has, right? So you should estimate the cost of equity capital, because you cannot find the comparable cost of equity capital in the market, right? So that's why it is so difficult to find the cost of equity capital. So you can use the KPM. As we discussed the previous class, the rate of return is determined by the following formula of the KPM: the risk-free rate plus beta times market risk premium. So to estimate the fund's cost of equity capital, you need to know the following three components. First, the risk-free rate, and second, the market risk premium, and finally, you need to know the company's beta, right? Beta, right? So let me explain with some example. Let's suppose that there is a stock, Stansfield Enterprises, right? And this company has a beta of 2.5. this company is very sensitive to market risk, right? Like a systemic risk, right? And this fund is just 100% equity finance. There is no debt, right? So for this company, the cost of equity capital is exactly the same. The overall cost of capital like of this company, right? Also, let's assume a risk-free rate is 5% and market risk premium is 10%. So the question is, what is the appropriate discount rate for this company? So you can just get the or the cost of equity capital using KPM as follows. So just what is the cost of equity capital? 30%, right? 30%. So getting the cost of equity capital from by using the KPM is very easy. It is very straightforward like this. All right, let me explain about the advantage and disadvantage of this approach. If you look at the advantage of this approach is that it first of all, this approach explicitly adjusts for risk, right? Because KPM, one of the important component of KPM is the market risk premium, right? But this approach is talking about the risk as well as the return, right? The second, it is applicable to companies who do not pay the dividends, right? For the DGM model, DGM approach can be applicable for the company who pays the dividends, right? But this KPM approach, it can be applicable to companies who do not pay the dividends. So it's more, comprehensive. Now, what is this advantage? The most, the drawbacks of this approach is that you should estimate the market risk premium, and you need to know about the beta of this company. But we already discussed that the beta is quite different, source by source. So it is very, so for some company it is very deviated. It has a very different beta by the sources. So this is so it might be inaccurate if you use very different beta or different market risk premium. So that is this disadvantage for this approach, right? So we need to understand what is the advantage and what is disadvantage of this KPM approach, right? All right, so let me stop here, and then we will discuss this subject later, the face-to-face class, all right? All right. Thank you very much today. All right. See you later.